Monetary ratio's got to be a minimum of 15 to 1, if not 10 to 1. So if gold's at 4,000, silver would have to be 400 to have any meaning. If it's sitting there at 50, its meaning in the financial market is 0.02% of the financial, whereas gold is maybe 0.5% of it. So if we go to where we were in 1980, where gold represented maybe 5%, we might get halfway there. So let's round up and be very generous, very conservative. Say gold's 1%. So if it goes to double, 2 or 2.5, we're doubling gold. And that could send the price at least double. So we're looking at maybe $8,000. But for silver to have meaning, it's got to get into a number that is a monetary.
David Morgan breaks down the monetary significance of silver relative to gold, emphasizing that silver must reach a meaningful ratio to have an impact on the financial system. With gold at $4,000, he argues that silver should ideally be around $400 to maintain its monetary weight. Yet it remains near $50, representing just 0.02% of the financial market compared to gold's 0.5%. Looking back at 1980, when gold comprised roughly 5% of the market, he suggests a conservative scenario where gold might double to 1%, which would naturally push silver higher as well. This highlights silver's latent potential. As gold continues its climb, silver's price could experience a proportional surge, moving toward levels that finally give it real monetary relevance and impact. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
It tells me that it's a very strong bull market. Silver usually leads gold. It's more volatile, so you'll see bigger move up and down in silver. The 50-day moving average on silver a week or so ago, I haven't checked in the last 5 trading days, was 45, and we haven't even touched that. And in a very, very strong bull market, I use that adjective twice, the commodity, the stock, whatever we're analyzing technically, hits the 50-day moving average and bounces off. That's a very strong market. And we haven't even gotten that low yet. And I add the word yet because it could be we're in a trading zone in both the metals. They establish a trading zone. We call it a channel formation technically, but it bounces for illustrative purposes. Gold bounced between 4,000 and 4,200 for the next 2 months. And that's the trading range. It's established. It's provable. You could draw the parallel lines. And then for whatever reason, it drops out of the 4,000 and drops down to 3,800 rapid. And then it starts going sideways. So that's moving out of the channel and forming a lower trading range. Does not mean the bull market's over, but it indicates as a fact that the bears have more control than the bulls at that moment in time. So to put it in a punchy way, the market knows more than anybody, and we watch it carefully. I would be surprised not to at least test the 50-day moving average. Now, remember, Gary, you know this, but maybe some of the viewers, it's been such a strong bull market, the 50-day moving average as we speak may be $45.25. In other words, the momentum has been up, 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 and up, and we've only now started to come off slightly. And there's a lag. The 50-day moving average is, going to continue to go up, and then it will follow the market real time. So the point being is I'm convinced we're in a major leg of a bull market, but we could get into periods of consolidation that may wear out people that are really looking for the fast trade, the quick buck, the momentum, that type of thing. I really have a hard time saying why anyone would do that. It hasn't been done for so long. So for silver to take on a monetary role, which is what we're suggesting, and I haven't talked to Randy directly, but that's what it indicates. Silver's got to be money again. And for silver to be money again, it's got to have a monetary ratio, which means the monetary ratio's got to be a minimum of 15 to 1, if not 10 to 1. So if gold's at 4,000, silver would have to be 400 to have any meaning. If it's sitting there at 50, its meaning in the financial market is 0.02% of the financial, whereas gold is maybe 0.5% of it. So if we go to where we were in 1980, where gold represented maybe 5%, we might get halfway there. So let's round up and be very generous, very conservative. Say gold's 1%. So if it goes to double, 2 or 2.5, we're doubling gold. And that could send the price at least double. So we're looking at maybe $8,000. But for silver to have meaning, it's got to get into a number that is a monetary. Now, I'm not saying it couldn't. Now, I'm going to put on my hat for a moment, Gary, and just go one step further. It's possibility that that's a bit of a ruse to get silver onto the balance sheet for industrial purposes. We're not going to run out of silver for our build out of solar panels. We're not going to run out of silver for our semiconductor factory that's going on in name the country. And there's 44 million ounces of silver per year in semiconductors. Think about that. Back in 1980, or not 1980, in 2000, 550 million ounces was the most silver brought above ground, byproduct metals, 70%, as you said. Go back to 1980, it was 350 million that was mined. And it was that way for decades. And I was going to digress, I won't digress further. But the point is, it could be either of those. I always think outside the box, and I could be way off on we'll need it for our balance sheet. But really, look at Russia. They bought it. They didn't say why. For as far as I'm concerned, strategic metals, and just going a bit further, if it does get to the critical minerals level, which it's a candidate to be on the critical minerals, but the vote hasn't happened because of government shutdown. Well, let's say the vote says, yes, it is a critical. What happens then? If we've had a 200 million ounce deficit for 4 or 5 years, and the U.S. government says this is strategic, this is for national security, and we need to build a stockpile of 140 million ounces, which is what it was when they stopped this metal inventory and started the Silver Eagle program. We go back to that. Now that year, if they did it in a year, would be an additional 140 million ounces on top of the deficit they already have. Whereas India started a silver ETF. They're importing silver like they can't ever get enough. They're also building one of the largest solar facilities in the world. China is kind of neutral on their solar, but it's very hard to get good data out of China. But they're still building it out. And then you got all this AI stuff with these data centers using more and more electronics and more power. Anytime you use electricity or electronics, silver's in the equation. For silver to get overheated, it would have to get to a gold-silver ratio of 70 or lower. And I think it might have got under 80. I'd have to look, but 80 is about as good as it did. When I started my first website, silverinvestor.com, I started with a gold-silver ratio of 80, and I knew that back in 2000, 2002, and at that time, if you would ask me, I'd say 80 is the highest gold-silver ratio we're going to see from this point forward. And I was right, actually, for some time, because silver did outperform gold from 2003 through the last day of April 2011. And then, of course, we went in that sideways or down pattern for a very long time. And now we're back up going into the last leg. But it's been as high, over 100 a couple of times since then. So silver's actually performing well, but not what I expect by the end of this. And again, 70 is my number. Why is it? Because of my years in the market. It's an art, not an exact science. It's not, no one's written a book on why 70 gold-silver ratio is enough proof that silver is accelerating and outperforming and doing an overperformance relative.
David Morgan highlights the dynamics of silver in today's market, emphasizing its role as a leading, more volatile metal compared to gold. He explains that silver must reach a meaningful monetary ratio, around 15 to 1 or 10 to 1 relative to gold, to have true financial significance. With gold at $4,000, silver would need to reach roughly $400, far above its current price, to have a significant monetary impact. Morgan also notes that industrial demand, strategic stockpiling, and geopolitical moves, such as India and China's accumulation, add pressure to the market. Considering deficits, critical mineral status, and supply constraints, silver is positioned for significant appreciation. Using historical gold-silver ratios and past performance as a guide, he expects silver to accelerate and potentially outperform gold as it approaches a ratio near 70, signaling the start of a primary bullish phase. Let's get into the interview.
Exactly, and then you'll have a bidding war. You have a bidding between industry that has to have it or they're out of business, especially when it's inelastic on the demand side. My flat screen TV in the other room uses whatever it is, 0.152, ounces of silver, but it won't be a flat screen without it. So if silver costs $10, $50, or $100, they could care less, because you're looking at, 20 cents, $2, or $20 for a, $500 item. So they really don't care. And they know they can't build it without it. So that means They might say they care, but really, no. So that's going for silver. And the other thing is the investment demand, once it starts, it's hard to stop because it is such a small market. And this is what happened in the 70s. People saw gold flying. Wait a minute. Back in those days, I was working for $6 an hour back then. So you looked at gold at, 400 or 500. I mean, that was like 2 weeks' salary. And you go, man, I can't afford gold now. But silver was still only, $30 or 25, whatever it was, still hit the 50. And so you saw a lot of people that spelt over into the safe haven of gold that bought silver instead because it was affordable. My basic premise that I would have said back in, 2000, 1999, when I started the Morgan Report, that the last phase of the market is the fastest and most lucrative. So I still believe that's the case. But you can make a great case for a 10-year market, especially with the deficit in silver over the last 4 or 5 years where we've had to eat the above ground stockpile to balance supply and demand. And if you got to eat the above ground stockpile year over year over year just to balance supply and demand, somewhere you're going to start running out of that stockpile. It's going to get pretty small, and anybody can look and see it for what it is. And there may be a run to silver just because it's becoming more and more valuable as far as how many ounces are available. All of that aside, I think I'm right because these markets move in that fashion. That's been proven many times by the market itself, not by what I think. And I've wanted to think, well, okay, how would it be that way? And the answer is a new monetary system. So I think you could see silver and gold surge, platinum, palladium probably go along with it because even though they're not monetary metals, they are in the precious metals category. And as I said at the end, most of these caveats, well, it's got to be this or it's got to be that, or no, this is safe. I believe it. It's scarce, and I have it outside the system. It's real wealth I can hold outside the banking system with no counterparty risk. You can't sell me gold for a month. What have you got? Oh, you got platinum? Okay, I'll buy it. Yes, I do, but it will be up and down, up and down. And that last part that we are talking about, that's at the very end. And I see that from my work about 1.5 years, maybe 2 years at the most from me. So that, oh my God, I want platinum if you don't have gold. That isn't going to happen next month. That isn't going to happen on the next breakout. That's going to happen when gold's hitting whatever it hits. I don't know if it's 5,000 or 10,000. When we get into that, oh my goodness, I've got to own gold. Sell all my stock, buy gold. When we get in that panic mode, then that's when.
So all this,
but
all
we
of
are
this,
going to hit that in this last phase. It's just, it's not like the next breakout. Next breakout back it up, but eventually it just shoots. And maybe the best way to do it is an analogy I've used in the past. I said the run to gold started about 2 years ago, and I believe I've been proven right. And remember, there's no fever like gold fever. I mean, once the panic begins, everybody's going to want it, but it's a short duration. So the run to gold goes like this. Here's my analogy. I've said it on other shows. Start off in like a real weak walk, and then you go to a normal walk, and then you go to a brisk walk, and then you go to a light jog, and then a jog, and then a fast jog, and then a light run, and then it goes to an all-out sprint. We're not at the all-out sprint right now, but that's what I've been discussing here. Yeah, But where are we right now? Right now, I would say we're at a light jog to a jog, but we're in the run. Now, the walk started with the central banks buying gold hand over fist year over year, but they're the smart money. They're the stealth move. They're the ones that no one's paying attention to unless you're David Morgan and other in my peer group. I'm certainly not the only one. People who pay attention to these markets like I do saw that shift, and I called it out. But going back, well, they were buying at 2000. 2000 was an all-time high. Yeah. And where is it now? Double that. And how much did they buy? Tons. And we're still not done. So I hopefully that helped kind of solidify where I see it and where we're going. It's acting as a monetary metal again. The last part of a major up leg, which happens in almost all markets, real estate, the stock market, almost any commodity. And what's unique about this one is not only is it the third most powerful leg up, it happens in a shortened period of time. In other words, this bull market's been going on from the year 2000, basically. You could put a marker somewhere else, but that's where I measure it. The point is that silver's, like any market, moves at the margin. The marginal buyer isn't an industry. Industry ebbs and flows. Trend is up, 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 and it cools off a little bit, but it continues. That's steady eddy. That's not going to vary. What varies is silver worth owning as a hedge against inflation, as monetary security, as political stronghold as far as the political structure breaking down, government breakdown, whatever. And once it takes on that role, then it's in a new dynamic. And that's where we are. So we're going to see, I think, 50, 60, 70. No one knows how high is high. But what we do know is that the mainstream has started to come on the gold bull market. There's not only well-known stalwarts in the investing world that have basically endorsed gold, but you even have some brokerage houses that said you should weight gold as high as 20%, which is unheard of. I mean, when I was saying 10%, I was a crackpot 10 years ago. And now someone from mainstream is saying, more than I usually am.
David Morgan explains that silver is entering a critical phase of its bull market, driven by industrial demand, scarcity, and its emerging role as a monetary metal. Industrial users, indifferent to price, create inelastic demand, while investment demand amplifies upward momentum in a relatively small market. Historical patterns suggest the final phase of precious metals cycles is often the fastest and most lucrative. As gold and silver assume monetary significance, panic-driven buying is expected to accelerate, with mainstream investors beginning to recognize their value. The current market is still in the early stages of this acceleration, progressing from steady accumulation to a full-blown run. Strategic central bank purchases have quietly set the stage for this surge, underscoring the scarcity and importance of these metals in the evolving financial system. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.